It's no longer just theoretical. We're now getting the early results from the global impact of trade wars and trade restrictions, combined with the fragile economic climate. While central bankers are out there talking about huge degrees of uncertainties to the point that they paralyze themselves, the early results and early returns so far paint an increasingly grim picture of the downside case, and maybe even the more extreme downside case. The global trade system is seeing massive cancellations, especially anything containerized. Having already front-loaded trade over the last 2 months of last year, and then again to a degree last month, the payback is definitely here, and there is little that is uncertain about it. South Korea reported on its highly watched export figures for the first 20 days of April. As a key global bellwether, the outcome there drives a lot more than perceptions. There are further upstream consequences as trade both in and out of the country was a lot weaker than hoped. Yet the Bank of Korea last Thursday cited the same uncertainty for doing nothing, even as it has drastically downgraded its latest forecast to include a potential minus sign now. And it isn't just Asia or other parts of the world. The early returns so far domestically here in the United States are getting to be just as grim. The Conference Board's LEI, for example, just today dropped sharply, though nowhere near as bad as one key region for American manufacturing, which saw its April order book just completely disintegrate. We've moved on from what might be happening to increasingly what is happening, or given the data that we're getting, the amount that isn't happening. Given so many distortions in the global economy already, fragility, that's what's really standing out as far as the early returns from tariffs, trade war, and the trade economy. There's just too many negatives for the world to have withstood, and so the data that's coming in is looking like, as you would expect, not a high degree of uncertainty, but more and more certain. And that starts out with major cancellations on anything being transported in containers. According to CNBC, U.S. importers are being notified of an increase in canceled sailings by freight ships out of China as ocean carriers try to balance the pullback in orders resulting from the tariffs and the escalation of tensions in the trade war. A total of 80 blank or canceled sailings out of China have been recorded by freight company HLS Group. It wrote in a recent note to clients that with the trade war between China and the U.S. leading to a demand plummet, carriers have started to suspend or adjust trans-Pacific services. We have no way of knowing how significant this drop in orders will be on vessel schedules, said Alan Murphy, who's the CEO of Sea Intelligence. There are no models to extrapolate this. What I can tell you is that the majority of containers on the vessels servicing the Asia to U.S. trade routes, that's China. We won't go to zero containers, but we will see a decrease in containers, and as a result, in the future, we will see a massive raft of blank sailings announced over and above those that already have been announced and those that have been canceled. Booking volumes from the last week of March to the first week of April across global and U.S. trade lanes plummeted. There were sharp decreases in bookings across several categories, including apparel and accessories and wool fabrics and textiles, both down over 50%. Of the results that were reported so far, the week-over-week changes in ocean bookings between the end of March and the first week in April, global 20-foot equivalent unit containers down 49%. Overall U.S. import, 64% decline. Overall U.S. exports, only a 30% decline there, but only 30% is an absolutely massive decline to begin with. Imports coming from China, containerized shipments, 64% drop there. And exports to China, down 36%. So a huge drop off in trade bookings and demand for trade, especially containerized trade. But it's not just containerized trade, we'll see in just a second. It's not just China either. But a huge drop in trade after the economy experienced the distortions of tariffs. First of all, weakening last year, but then the artificial high, front-loading the trade restrictions last couple months of last year. It fell off early part of this year, but then when tariffs were delayed and there wasn't a set schedule to them, there was another artificial high February heading into March, leaving the entire system completely front-loaded to those couple months last year and the first couple months of this year, meaning that the payback was going to start here in April. The implementation of the tariffs plus all that front-loaded activity means a huge air pocket across the global trade system. And that's what we're getting, not in some type of theoretical forecast, but that's what we're seeing already in the data that's coming in. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store of value hedge for years. In fact, it's the ultimate error hedge. But if all you're doing is owning gold, you're only preserving your wealth, not growing it. And that's where today's video sponsor, Monetary Metals, comes in. With Monetary Metals, you can earn up to 4% in their leasing program immediately upon funding your account. And there are higher yields available to accredited investors in their bond offerings. The interest that you earn on your physical metal is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver while you hold them. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. For China specifically, the country had reported for the month of March a pretty sharp increase in the dollar value of exports sent around the rest of the world. They increased 12.4% year over year in March alone, which was way above expectations. Not only that, that helped China meet its GDP target or meet the GDP rate from the fourth quarter at 5.4% year over year, though it did slow down to 1.2% quarter over quarter rate. However, just getting to that 5.4% year over year change, almost 40% of the increase in GDP in China came from net exports, which was the highest share of GDP and GDP growth in well over a decade. Meanwhile, on the other side of that, as China's economy continues to struggle, imports coming into China were down 4% by dollar value in March, after being down by more than 8% year over year in the January to February combined period. So that gave China a huge, massive trade surplus and therefore higher GDP. That wasn't legitimate organic growth. That was, as I just mentioned, more artificial highs, front-loading of activity to beat tariffs, which means the payback period in China already begun and likely to be pretty darn substantial. Not only is that a threat to the trade system overall, it's a threat to the Chinese domestic economy, not just in terms of GDP, but in reality, because so many factories in China have depended upon the export business just to keep things running. And without the export business getting into this air pocket in the payback period, a lot of factories are going to have to cut back. In fact, there's already been reports that some factories have been cutting back on shifts. Workforces that used to work 6 days a week are now working maybe 3 or 4 days a week. As a result of all this, I mean, even economists at the Wall Street firms like Citigroup and UBS are now cutting their GDP growth forecast for China to 4% and even less, while at the same time, of course, calling for more stimulus from the government, because of how weak the Chinese economy is likely to be after all of this artificial distortion works out. In addition to container shipments, you look at something like the Baltic Dry, which is dry goods, therefore raw materials. The Baltic Dry Index, as of last check, was 1261. Now, while that's up from the seasonal low, which this year the seasonal low was really low, back to like 2023 levels rather than last year, the seasonal low this year was 715 back on January 29th, just before the Golden Week holiday. And then, as usual, seasonal pattern that picks up as demand from China coming off of the Golden Week holiday and get back to work, got up to around 1669 on March 14th. But since then, as is consistent with the seasonal pattern, it's been moving weaker. But this year's seasonal weakness is a lot weaker than certainly last year. Go back to last year. The low in 2024 was January 16th at 1308. It jumped to 2419 on March 17th last year, was almost 800 points higher than the seasonal high point March 14th of this year. And then it backed off, as is typical for the seasonal pattern, to 1882 by April 21st of 2024, which, as you'll notice, well above, 600 points above where we are currently. So demand has fallen off more sharply for the Baltic Dry, and therefore demand to ship dry goods and raw materials around the entire world, not just China, though mainly China, compared to even last year, which wasn't all that great. In fact, we're getting back into the same type of territory that the Baltic Dry and therefore the global trade system was in 2023, which was not a good year for the global economy either. But it's not just China. South Korea just reported on the first 20 days of its export business, and South Korea is a big one. It's a big one because not only is it one of the largest trade economies in the world, it is also interconnected into all of these different places, the US as well as China, and a whole lot of stuff in between. A lot of key commodities, a lot of key goods, automobiles, semiconductors, basically everything you want to know about the health and the condition in the global trade network. You look at South Korea, and that's why South Korea's initial results is very disheartening. And one of the world's first trade figures for April to come out after Trump ratcheted up his tariff campaign, the value of South Korean shipments adjusted for working day differences, which there weren't any in this month, fell 5.2% from a year earlier in the first 20 days of April 2025, at least according to the data released today by the Customs Office. That compared with a 5.5% rise reported earlier for the full month of March. So from plus 5.5% to minus 5.2%, reflecting the big time change in between. Front loading of activity into March, one last try to get everything shipped and in the US and wherever else it was going before trade restrictions and tariffs were implemented, leaving the payback air pocket here in April. And now you know why markets have reacted so negatively to all of these developments. Markets can see in the real economy, not just distant forecasts, but the results that are happening right now. South Korea showed outbound shipments to the US and China were down 14.3% and 3.4% respectively, while exports to the European Union and Taiwan were up 13.8% and 22%. The other side of all this is not just weakness to the US and China, the belligerents in the trade wars, but also everyone else, because South Korea is going to look to try to make up the lack of demand that it's getting from both of those places, and so try to sell whatever it has in hand to other places around the world, like Europe, like Taiwan, like other places in Asia. So you're going to see what amounts to a deflationary snapback is what amounts to overcapacity. All these different places around the world are going to try to compete with what few markets are not distorted by trade wars, trade restrictions, and general global economic fragility. And as the article continues, the auto tariff presents a real threat to South Korean automakers since the U.S. accounts for nearly half of the nation's $70.8 billion worth of vehicle exports in 2024, at least according to government data. Automobiles and auto parts are among South Korea's biggest export items to the U.S. and therefore very vital to the South Korean economy overall. And given these early returns, as well as some other problems that South Korea is experiencing related to fragility in the global economy, even before we get to tariffs, you'd think that the Bank of Korea would be reacting to it in the same way that central banks usually do. But in this case, the Korean Central Bank, like others around the world, like the Bank of England that we've talked about before, they're paralyzed by inaction given what they say is a high degree of uncertainty, even as the certainty of the downside case emerges more and more concretely in all these early returns that we're getting to this point already. Just last week, the Bank of Korea announced that South Korea could see negative economic growth in the first quarter of this year compared to the previous quarter. And the central bank also indicated that it plans to adjust its economic growth forecast downward even more than it already has. Despite that, they opted last Thursday to keep their interest rate at just 2.75%, reporting that, quote, while inflation remains stable, downside risks to economic growth have intensified due to the sluggishness of economic activities in the first quarter and due to the deterioration in global trade conditions. So that doesn't seem to make a whole lot of sense, especially as they continued. The GDP growth outlook is expected to fall below the February forecast of 1.5%. Now they're saying that's not even close to enough, and there has to be further downgrades to economic growth forecasts here in 2025. And yet, they didn't do anything as far as their interest rates. One hand, because they're thinking, well, if the government in South Korea implements a huge stimulus program like we see in Germany, that might lead to inflation. But also, like we see in Germany, there's not a whole lot of expectation that'll be the case or that it'll be effective, leaving South Korea, like Germany, to suffer the downside consequences of all of these distortions hitting negatively at the same time. So as far as South Korea is concerned, they're getting into some of the worst downside cases already. The early returns are not encouraging. You think that's, well, okay, that's Asia, that's South Korea, that's China. But here in the US, we're largely insulated from all the consequences and fallout. But as far as the goods economy, I've already talked about the services economy, but as far as the goods economy, not so much. The Conference Board today reported its leading economic indicators, and there was a sharp decline in those. As the Conference Board press release said, the leading economic index for the US declined by 0.7% in March to just 100.5 after a decline of 0.2% in February. The LEI also fell by 1.2% in the 6-month period ending in March, a smaller rate of decline than its 2.3% contraction over the previous 6 months, and all that does is reflect the artificial high in between. The U.S. LEI for March pointed to slowing economic activity ahead. That's according to the senior manager for business cycle indicators. March's decline was concentrated among 3 components that weakened amid soaring economic uncertainty. They keep using that word. Ahead of pending tariff announcements. Consumer expectations dropped further. They didn't drop further. They absolutely plummeted. Stock prices recorded their largest monthly decline since September of 2022. And it wasn't just stock prices. Like I said, we saw liquidations everywhere. And new orders in manufacturing softened. They say it softened when it actually did a lot worse than soften. Even despite all of that, the LEI, or the Conference Board, says about its LEI, it's not forecasting a recession, at least not here, because it still captures the positive benefits, so to speak, from the artificial high last year. From the Conference Board's perspective, that artificial high wasn't a distortion. That was, to them, a more accurate representation of the economic, strong and resilient economy that Jay Powell always talks about. When the marketplace is reacting to the artificial high last year being artificial high, and the downturn that we're seeing now emerge this year being the real economic condition, the one that we need to really worry about. As far as manufacturing orders softening, just last week before the holiday, the Philadelphia branch of the Federal Reserve reported a plunge in manufacturing activity, indicated manufacturing activity in that region of the U.S. economy. The PMI, which had been +6 back in October, that's part of the artificial high, then fell to -10.9 in December as the artificial high came down, and then absolutely soared to +44.3 in January as the manufacturing economy, not just in the Philly region, got to experience one last hurrah before the rug got pulled out. It got to +44.3 in January. By March, it was +12.5, and here in April, -26.4. In the order book specifically, the new orders index had been +42.9 in January, reflecting that artificiality, the reborn artificiality, to get everything in ahead of tariffs. And yes, you do have to get everything in ahead of tariffs because a lot of components come in from overseas that need to be assembled here in the United States. So from +42.9 in January, the new orders index in Philadelphia fell to -34.2 in April for a 75-point swing in a matter of 3 months. The sharp drop-off that's consistent with all the rest of the stuff that we just talked about, from South Korea to the cancellations of containerized shipping from China to the U.S. They kept saying strong and resilient all last year, early part of this year. They looked at the artificial high as an actual high, not actually artificial. And instead, the markets kept warning, fragile, 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 especially from last summer. Keep looking at the Philadelphia Semiconductor Index in the stock market. The stock market of all places saying, whoa, hey, the cyclical forces in the global economy, the U.S. economy too, are moving in the wrong direction. And they were not coming back last year for anything more than short-run artificial distortions. Now we get to the other side of them, plus the impact of tariffs themselves, and the early returns so far are very far from encouraging. We knew there was going to be a downside case during the payback. We weren't really sure exactly how big that would be. The markets were concerned it would be a big impact, which is why there's been so much financial volatility over the last month or so, month and a half. The concerns were there, and now we're getting the data this side of the tariff implementation, this side of the payback, and it is, like I said, not just confirming the downside case, it is more and more looking like the downside case that is emerging already is among the worst scenarios in it. So the negatives are already starting to pile up. China, South Korea to begin with, but it's not going to be just China, South Korea, or Asia. There are going to be consequences globally, including here in the United States too. One major central bank threw aside uncertainty, said, yeah, we see the downside case, which is why markets there are pricing a high degree of possibility of ultra low rates, if not zero. And that was in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.